Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment is brought to you by C5 Plus CCIM Global Summit. It will be in Atlanta this year, September 28th to September 30th. And there's a lot of great speakers, including Casey Conway, David Robinson, Chris Voss, and yours truly, Michael Bull, and some other great speakers. It's a great 3-day event. Learn more at c5summit.realestate. Well, we have a great show for you today. We're going to talk about the office market, and I think it's really the most interesting sector right now because of all the question marks, right? With some companies downsizing, some companies still working from home, but yet we're starting to see some companies want the benefits to the employees and, in my view, and to the employers of getting back in the office and requiring more folks to get back into the office. But how is the office market performing? And of course, we've had huge, quick, fast interest rate hikes from the Fed. And it almost seems to me they're just trying to really wreck the banks and, and the economy. And they're doing a pretty good job so far. Well, please welcome my guest. It's Phil Mobley. Phil is National Director of Office Analytics with the CoStar Group. Phil, good to see you. Thank you for joining us.
Yeah, thanks, Michael. Always a good time when we have these chats. So pleased to be back on the show.
Well, thank you. And first of all, let's kind of look at the office market overall. When you look at the entire U.S., how is the space performing right now?
Well, it continues to be challenged. We've got vacancy, the way we track it, at 13.3% today nationally, and that's up from 9.5% entering 2020. Now, we at CoStar track sort of the entire universe of office space, including owner occupied and medical. So if you exclude those two groups, the owner occupied properties and then medical office, then you can add roughly 400 basis points to that vacancy rate, putting it at around 17 plus percent. And that's probably more in line with what you might see from reports from some of the major brokerages who tend to focus on that least competitive space. But really, we're all seeing the same trend, this upward trend rise of 400 plus, almost 400 basis points since the beginning of 2020. From an absorption standpoint, we've seen tenants give back about 160 million square feet since the beginning of 2020, including about 48 million so far this year. So there have been some ups and downs since 2020, and I'm sure we'll talk more about that. But from our perspective, it's a soft demand market, and we expect that to continue, frankly. Our forecast has overall vacancy going up to 17%, with that non-owner occupied, non-medical going up over 21%, sometime around the end of 2026. So we see kind of a long road ahead before we hit the bottom in terms of the overall leasing market. The rationale for that is essentially that over half of leases that were executed pre-pandemic have yet to face an expiration event. And as those roll in the next few years, we expect tenants to continue to behave more like they have in, say, the last 6 or 9 months than the way they behaved in, say, 2018, 2019. So we think this negative demand shock is going to continue to play out. Our forecast does still include a mild recession happening, beginning at some point over the next 6 to 9 months. And so that just kind of adds to the situation on the demand side. Now, this is a really uneven way that we see this playing out, and we'll talk some more about that. But from a valuation standpoint, we see values down about 10% so far based on what transactions have occurred. We forecast values to decline another 20 or so percent, again, by around 2026. And that would be a total decline of total price correction in line with what we saw during the Great Recession, which I think intuitively makes some sense, right? When you think about what happened to the economy then, what's been happening to the economy, but the office market in particular in the last 3 years. So we've got a long way to go, but I do think, and as we talk further about this, I do think we have a little bit more understanding of which types of properties, which markets will perform relatively better and worse as we move forward.
That overall decline for office values around the US, you said a total of 30%, or was that a total of 40%?
Total of 30% is what we're forecasting. Now, we've already seen some properties retrade at values lower than that. So, a couple of resales in San Francisco that are 40, 50, 60% below what they might have sold at in the 2010s. So that's the average. There will be relative winners and losers, as there always are in times of economic challenge.
Yeah, and I guess you see that in class of building and geographically, right?
We do. So, class is an interesting one because we see higher cap rates on the Class B as opposed to Class A. On the other hand, we actually see higher vacancy in Class A overall as opposed to Class B. And so there's an interesting dynamic going on there. Part of that is because when new space delivers to the market, it tends to come in disproportionately at the Class A level. So there's a denominator effect going on there that keeps vacancies a little bit higher. Um, Part of it as well is that the Class A slice of the market is where we see the majority of this record level of sublease inventory. We have sublease inventory up well over 100%. I think the last time I checked, it was up 130% or so from the end of 2019. And that space tends to be concentrated in the Class A slice of the market. Um, so, by the way, that sublease space is about 60% vacant already, which is also unusually high. So not only is there more sublease on the market, but more of that space is vacant, which I think really indicates that it's superfluous to the master tenant's needs right now. So we'll see how that plays out. It's one of the things I'm watching really closely.
Yeah. What about geographically? What differences are you seeing there?
Well, there are big differences geographically, and I think one really important point to make about what's happening in office is, uh, as I think we've intuitively suspected for a while, there are going to be neighborhoods and markets that feel very strong and very, I'll say normal relative to what we got used to in the late 2010s. If you look at a market like Miami, it's performing very well. If you look at a market like Las Vegas, it's performing quite well. And so, the long-term demand drivers of population growth and corporate migration to the market, whether that's relocating their headquarters or establishing a regional office and a net new regional office, those things are in play in some markets like that, those Sun Belt markets with relatively diverse economies, and I'll come back to that. On the other hand, when you look at downtowns specifically of major markets, they're associated with long, expensive commutes. They're associated, some of them, particularly on the West Coast, San Francisco, Seattle, San Jose, are associated with a high proportion of technology workers who tend to be the ones who attend the office with the lowest frequency. So those are definitely risk factors in terms of the markets or the submarkets or neighborhoods where these office buildings tend to be located. I think the other thing is the relative the relative distribution of commercial activity that's in a particular neighborhood. So what I mean by that is, if you think about the central business district of New York City or San Francisco, and the financial district in Boston, downtown Atlanta, even, then what you've got is a very strong concentration of office relative to other commercial property types. And on the other hand, if you think, so Michael, you're in Atlanta, if you think about what's going on near the Battery, where the Atlanta Braves stadium is, um, there's office over there, and I'd be willing to bet that's performing pretty well, in part because it is part of a more diverse ecosystem of commercial properties. It's the work and play dynamic. There's other attractions and activities to bring people to those neighborhoods, and office benefits from that. There's places that people just generally want to be.
Yeah, that's a good point, and I think, a lot of office users these days are trying to get their employees back in the office, and if they're in a location where the employees would like to walk out of the building and do something else, you know, be a popular area, that makes a lot of sense. So, what do you see for leasing trends, from tenants these days? You guys attract the leases as well?
We do, and it's part of what's informing our forecast being, on the pessimistic side. We do see continued net absorption in the next, call it 24 plus months. And one reason for that is what we're seeing in the leasing market today and over the past, I'll call it 9 months. I'd say the biggest thing that we're seeing is a reduction in the average size of a new lease, certainly relative to what we saw in the 5 years leading up to the pandemic. We see average sizes down about 20%, which is bringing down total leasing volume. And, leasing is a leading indicator of absorption. So in the coming 6, 9, 12 months, we think this is going to show up in the actual absorption stats. But in terms of the number of tenants active in the market, the last 6 months or so, that's been relatively normal. It's been close to what it was in the late 2010s. The difference is that those tenants are taking on smaller leases, and there's two things, at least two things going on here. One is that you've got larger companies that when they face those lease expirations, they are taking less space. They have a lower need for space per worker than they once did. Um, Part of that is certainly related to lower office attendance, hybrid work arrangements. I think part of it is they're actually paying attention now to utilization in a much more disciplined way than they may have been 5, 10 years ago. And I think another piece of it is, um, though hiring has certainly slowed recently, even as these companies continued to hire in the last 3 years, they realized they didn't necessarily need to acquire and commit to space in advance of onboarding new employees, that they were able to do that under a flexible workplace model, without committing to more space long term. So big tenants are tending to take less space, often associated with moving to higher quality space or space that works better for them and maybe a different submarket or different building. And the other piece of this is that smaller tenants are disproportionately active in the market right now. So, if you think of a small law firm or CPA firm who may have been in one location for the last 10, 20, 30 years, well, now they're looking at the market and they're thinking, well, we could get space in a high-rise building in a different town, a different submarket, maybe downtown, brand new building that's being delivered in a different area. And they may not need less space. They may be working in much the same way that they did in 2018, 2019. But they just happen to be relatively small users, 2,500, 3,000 square feet, as opposed to your 100, 150,000 square foot large tenants. And so these smaller tenants, we see them being less likely to just renew in place and more likely to pick up and move. So even if their space requirement doesn't change, they are representing a larger proportion of the tenants in the market. And that's also helping to pull down the average lease size.
Yeah. Well, it's certainly a great time for tenants to lease space or to buy buildings. We've certainly seen good activity at our shop on government leased buildings and on medical office buildings and on user activity. To your point, out there looking, hey, this is a great time to maybe upgrade my space location, maybe attract my employees back to the office. One of the things we're also seeing selling office buildings is the utilization of these smaller tenants. To your point, they're using their space more too, right? They're in there using the space as some of the larger tenants. You go in and it's a bit of a ghost town. One of the things that, of course, we're dealing with in every sector and certainly in office as well is the rapid rise in interest rates. And you talked earlier, Phil, about the decrease in values that you guys are seeing around the country overall. What are you seeing for lender trends related to distressed loans when some of these office buildings just really don't have the NOI for the debt coverage? What kind of trends are you seeing?
Yeah, well, it's tough. I mean, one thing that we've seen in our CMBS data is the delinquency rate rise fairly sharply so far this year. Actually, didn't rise all that much in August. It's just south of 5%, which historically is not great, not terrible for the office market. I think the fact that it has risen so quickly from about 2% at the beginning of the year up to close to 5 now is a warning. The rest of this year, so just the last quarter and a half of this year, has a lot of CMBS loan maturity coming due, and so compared to maybe a full year in 25, 26, 27, it's about the same amount, $15 billion or so. And so that combination of loans maturing, more of these owners struggling or choosing not to pay, with the delinquency rate rising, I think that's a warning sign for sure. So if you look at, for example, the regulators, the FDIC, the Federal Reserve, the Office of Currency Control, that have come together in the past and again recently to provide guidance on loan workouts. They did this after during the Great Recession. They did it again a few months ago. And with respect to office buildings, their guidance included some notes on, hey, here's some situations you may find yourself in. One would be you own a building with a single tenant that occupies 80, 90+% of the building. They're using the space. They're extremely likely to renew. They've good credit tenant, like the tenants that you were talking about, Michael, including government. The loan is performing, and yeah, your NOI relative to your debt service may look a little different when you look toward working out or refinancing this loan, but that income stream is there, and the ratio may not be quite as high as we would like it to be, but there's latitude there to work out that loan and extend it, right? Because it's performing, the space is being used, there's value there. On the other hand, in a multi-tenant building with a lot of near-term lease exposure and some major tenants that are not using the space, very underutilized, then that's a really big red flag. It's going to be hard to work out those loans. The regulators are going to put a lot of scrutiny on that. That even if you could sort of write out the pro forma and make the numbers work, just the risk involved of actually attempting to retain those tenants, the low utilization is a sign that they're unlikely to renew in the eyes of the regulators. So those will be much harder to work out, and I think trigger some of that further 20% decline in volumes that we are forecasting. So the combination of maturities, of lease exposure risk, that's the combination to really watch for in terms of when and how quickly the market's gonna continue its shift that we all see coming.
Yeah. Well, it's interesting times that we're in. We just took over a bank foreclosed office building that was mostly all vacant, and surprisingly enough, we got it under contract within 30 days and just had a lot of interest. So, one borrower and bank's problem can be another investor's opportunity. Phil, and where do you see opportunities in the market, either geographically or class of building or user, or what do you see?
Yeah, well, I mean, I think what we've seen so far is that in the last 3 years, in the aggregate, tenants have preferred high quality, premium quality space that they acquire directly from landlords. So at CoStar, we use a star rating system that's analogous to, the class rating, class A, class B, class C. We use 1 to 5 star, with the idea being that a 5 star property in one market is comparable to 5 star in any other market. So we try to make it kind of geography agnostic. And so what we've seen is that the demand for space, net absorption, has been positive in 5 star space that tenants acquire directly from landlords in the last 3 years, and has been negative everywhere else in the aggregate. So that's an interesting signal to me that it's the clearest definition or example of the flight to quality trend that we've all heard so much about. On the other hand, even within 5 star inventory, we've seen sublease inventory increase. And that to me suggests that at some point that I expect will be soon, we're going to see tenant preferences begin to shift, because I think that space, 5 star space being high quality, well located, desirable space, I expect that we're going to see that sublease inventory come down at the top of the market. We haven't yet, so we've seen tenants still continue to prefer direct space, and I think that's because they're looking at, number one, the quality of the building, number two, the quality of the build out. And so the landlords have been willing and eager to do all they can to get tenants in that space, including generous TI allowances, other lease concessions. But there's a limit on how far they can go, particularly in this environment where we've seen interest rates go up so fast and so much. So pretty soon, financing those TIs is just not going to be feasible for the landlords, given the cost of capital that they're facing. So what I expect to see, although we have not seen it happen, at least in the aggregate yet, I expect to see this preference for direct premium space begin to slacken, as landlords are really just unable to offer any more concession packages that are just eating into their NOI. We've seen some that are 40-50% of the value of the lease if you look at it over the term. And that's just not going to be sustainable. So I expect tenants to begin to take a second look at this sublease inventory, which they can often acquire at a 30% discount or so, and say to themselves, yeah, we may not get this highly customized build out, but what we are going to get is a lower lease rate, and we're still going to be in this really nice building that we think is going to work well for us, help us with our work, help us with our talent attraction. So that's the thing that I am watching for in terms of a shift in the market, because on the one hand, I think that will be healthy. It will help us really find where the market is. And on the other hand, that 30% discount on sublease rents is going to have some downward pressure on rents overall. And similarly, our CEO pointed this out on CNBC a few weeks ago, that at some point, some of these buildings that are just not able to perform, they're not able to refinance. And to your point, Michael, another buyer could come in and see a real opportunity there. But that buyer, one strategy they may take is to come in and to lease that space out at, I won't say race to the floor, but at a discounted level of rent, right? That's going to be good for that building. It's going to be good for the tenants who move in there, but it's going to supply more downward pressure to rents overall. So tenants, if they begin to start favoring the sublease space, if they see these newly acquired or maybe even acquired in distress scenarios buildings where landlords are coming in at a low basis and offering lower rents, when we see tenants starting to prefer those types of spaces, I think we're going to really see the leasing market reset, and we're going to find where the bottom truly is.
Yeah. Also seems like a great opportunity for users, for tenants who do want to acquire buildings. And we've certainly seen that pick up as well. Is that something you guys track when a owner occupant buys versus investor?
Absolutely. And we've seen that as well. So, relative to its share of inventory, owner occupied space has performed better than would be expected.
Mhm.
So, it's something like in the last 8 years, it's something like 20% of newly constructed space has been constructed for owner occupancy, but it's accounted for closer to 25% of the space that tenants have actually absorbed. So yeah, we're seeing the same thing. Owner occupancy, medical space is still performing well. Essentially, no increase in the aggregate in vacancy and in medical office space.
Yeah.
So there are certainly opportunities in both of those types of properties.
Yeah, and of course, you guys see it, and our audience knows it. But every market's different, every submarket, and sometimes buildings across the street from each other can be doing extremely differently, right?
They can, and I think one of the real keys in thinking about the office market, and I keep hearing it said, and it's true that there is an analog to what we've seen happen in retail in the last 10 to 15 years, where the retail that's performing is doing really well. And the retail that's not performing is doing really poorly. And
Mhm.
there are still, some Class B malls that are um, still shaking out, right? Not a lot of activity happening there, and the municipalities in which they reside are thinking, okay, what can this space be converted into? And I think something similar is happening in office, where there are going to be neighborhoods where the office market looks like it's humming because it is humming. There are plenty of people there. The rents are stable or rising. The space is being absorbed, and there's a lot of vibrancy there. On the other hand, I think there are going to be areas where that's just not the case, and uh, it's going to be difficult at really any rent level to backfill some of the space that's in an undesirable building in a neighborhood that people just don't want to be in.
Yeah, it's interesting. We're seeing a good bit of mixed use development on some of these sites too, where some of these office environments are becoming more mixed use.
Yeah, well, I mean that makes sense as well because um, if you look at the performance of office in extremely office centric areas, your financial districts of major cities, they're not performing as well as those that are in more what I'll say commercially diverse areas. So higher proportion of uh, retail and even multifamily space, where these are areas that people want to be in regardless. Um, and so the office portion of those areas has tended to perform relatively better.
Yeah. Well, Phil, what would you leave our audience with to think about related to office?
I would say that the idea of being fully remote um, and companies working without offices at all certainly still a thing, particularly for your small tech startups. But for most companies, and you see Amazon even this week talking about the importance of being together. Um, that is a real thing. That people being physically proximate to each other is crucial for the performance of an organization. Now, you have to take that in context of what the big tech companies in particular are saying, but not just them. They're talking about coming back in this hybrid manner, 3+ days a week as opposed to all 5. And so there's an adjustment to demand, right? To how much space they need, how it's going to be configured, what type of space it is. And frankly, we are still waiting for the full reset of that so that we can understand what is the relationship of employment to need for office space. Um, so we're not quite to where we understand what that relationship is going to be, but I think it's very safe to say that there is still a relationship there. That there is still this need and this desire among employers, but also employees, to be physically together with their coworkers. Um, so the way I think we're going to see this play out is this winners and losers. I don't want to say zero sum game. It's been a zero sum game so far. It may not always be that way. Um, but yeah, there's a reset underway, but there is true value in good quality office space. Tenants still need that.
Yep. Well said. Phil Mobley, thanks for joining us, sir. Good work.
Yeah, good to be here. Thanks for having me.
All right. Thank you. And that's Phil Mobley. He is National Director of Office Analytics with the CoStar Group. And we thank you for being on. And thank you, audience, for sharing the show. Please subscribe. Please like. Please share. Please reach out to us. If you have any questions, thoughts, ideas for me, my email is michael@bullrealty.com. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For commercial brokerage sales and leasing in the Southeast U.S., contact our show host by email at michael@bullrealty.com. By Commercial Agent Success Strategies, 21 incredible one-hour agent training videos. Learn more at commercialagentsuccess.com. By C5 CCIM Summit, 3 days of commercial real estate networking, learning, and investing. Learn more and register at c5summit.realestate. And by Lument. For senior housing, healthcare, and multifamily financing, visit lument.com. For more podcasts and videos, subscribe and visit creshow.com.